Today, we are going to talk about a way of investing that for a long time was pretty much just for the big guys, the huge institutions. But that's all changing. And no, we're not talking about buying stocks. We're talking about something different, lending money. You see, there's this huge shift happening where banks are pulling back, and that's opened up this massive multi-trillion-dollar opportunity in something called private credit. So let's get into it. Let's talk about what it really means to be the bank.
So check this out. It all kind of clicks when you hear this story about a furniture company of all things called R.C. Willey. The real genius behind their business wasn't selling you a new couch, it was financing it. They figured out that the real steady money, the powerful cash flow, came from being the lender. And that one simple idea, that's the core of why this whole world of private credit has just exploded. And that brings us to the big question for today, right? What if you could invest with that same mindset? What if your goal wasn't just betting on stock prices going up, but earning a steady, predictable income from loans? You know, for years, this idea was basically off limits for most people. But now, things are different. New kinds of funds are opening the doors, letting everyday investors get in on the action. It's a totally different way of thinking about your money.
Okay, so to really understand this, we've got to start with the absolute basics. When you put your money into a company, you're really only doing one of two things. You're either loaning it to them, or you're buying a piece of it. You're a lender, or you're an owner. Let's break down why that difference is so incredibly important.
This slide really lays it all out, the two sides of the coin. If you loan it, you're the lender. The company owes you money, and your profit is the interest they pay you. Now that profit is capped. You only get what you agreed on. But, and this is the huge part, if things go bad, you are first in line to get paid. On the other hand, if you own it, you're a shareholder. The sky's the limit on your returns, right? But if the company fails, you are dead last.
Now that last point, about being paid first, that's not just a minor detail. It's everything. It's the whole reason why lending is seen as a safer bet than owning. It all comes down to something called the capital stack, which is really just a fancy way of saying, where do you stand in line when the music stops?
And that pecking order has a formal name, the capitalization structure. Don't let the name scare you. All it means is the hierarchy of who has a claim on a company's money. Think of it like a pyramid. The safest spot is at the very top. Knowing where you are in that structure is like knowing where the fire escape is before you even walk into the building.
And here's what that pecking order looks like in practice. Right at the very top, in the VIP section, are the lenders. The people who are owed money get paid back first from whatever assets are left. Then, way down the line, after all the debts are settled, you get to the shareholders. And who's at the absolute back of the bus? The common shareholders, the owners. They get whatever scraps are left over, if there's anything left at all.
And listen, this quote just says it all. It's not being dramatic, it's just the cold, hard math of a business going bankrupt. When a company liquidates, the lenders, the bondholders, are the ones who have the first real shot at getting something back. The people who own the company, their investment often gets wiped out completely.
Of course, not all loans are created equal. Being first in line is great, but it doesn't matter if there's no money left to collect. And this table from Moody's shows you why. If you lend to the highest quality companies, the AAA-rated ones, the chance of them not paying you back over 10 years is tiny, less than 1%. But look what happens as you go down the quality ladder. You get to the speculative stuff, and holy cow, the risk of default jumps to over 30%, a 1 in 3 chance they don't pay you back.
Okay, so far, lending sounds pretty good, right? You get steady income, you're first in line if things go south. So what's the catch? Well, there's a big one. And it is, without a doubt, the single biggest risk you have to understand in this world. It's what we call the illiquidity trap.
This quote absolutely nails it. Illiquidity, which is just a fancy word for not being able to sell something quickly, is a massive risk. And in private credit, it's not a bug, it's a feature. The whole reason you get paid a higher interest rate is because your money is locked up. You're being compensated for giving up access to your cash.
So what is illiquidity, really? It's simple. When you own a share of Apple, you can sell it in 2 seconds. But a private loan? There's no stock market for that. You can't just click a button and get your money back. You have to wait until the loan is paid off or until the fund pays you. Your money is, for all intents and purposes, locked up.
And here's the trap. Here's the brutal truth of it. When do you most want access to your money? Probably during a market crash, right? When fear is everywhere and everything is on sale. Well, guess what? That's the exact moment when liquidity completely vanishes. It's the ultimate catch-22.
This slide just makes it so personal and so real. With public stocks, you have all the control.
You get nervous about your investment in Coke? Boom, you sell. You're out. You're in charge. But with a private loan, if you change your mind, too bad. There's nothing you can do. You have zero control. You are a passenger on that ride until it ends, and that's a really big deal.
All right, let's pull all this together. We've seen why being a lender can be powerful, we've walked through the pecking order, and we've stared right at the brutal truth of being locked in. So, after all that, should you be a bank?
Look, it really boils down to this fundamental trade-off. The upside is clear. You get to act like a bank, collecting those steady interest payments, and you get that senior spot in line if things go wrong. But the downside is just as clear. Your returns are capped, no home runs here, and the critical risk, the one you cannot forget, is that your capital is illiquid. It is locked in, for better or for worse.
So the final question really isn't for me, it's for you, and there's no single right answer. It's all about understanding the different roles money can play. Is your portfolio built only to be an owner, chasing that huge upside but accepting you're last in line? Or is there room in your strategy to also be a lender, accepting those capped returns in exchange for income and a safer spot, but knowing full well you're giving up control and liquidity to get it? Thinking about that balance, that's the key.